Hello and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Wine, Beer, and Spirits Industry Tax Credits and Incentives. We're pleased that you've joined us today, and before we begin, I'm going to play our housekeeping video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, we have a couple of speakers with us today from Moss Adams. We have Adam DeZego, Director, and Ben Alderton, Senior Manager. Their bios and contact information are located in your webcast console. And also, you do have the option to submit questions for these presenters in the Q&A window. We have quite a bit of content to get through today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And now I would like to turn the floor over to Ben to get the presentation started.
Perfect. Thank you, Amy. And as Amy indicated, feel free to please put questions in the chat box so that hopefully we can address those kind of as we go along, because the more interactive we are and the better we answer your questions, probably the better Adam and I speak the whole time. So happy to answer your questions as we move along. I'm going to start out with a very quick overview of the Inflation Reduction Act, and then get into a little bit more of the specifics of how it might impact your specific industries, and specifically the wine, beer, and spirits industry. So the Inflation Reduction Act created an unprecedented opportunity for transitioning to green energy and manufacturing. There's a 10-year lifespan on the credits and incentives that are in the Inflation Reduction Act. Original estimates were somewhere around $370 billion of credits. We think that number is going to be much, much higher as we move through the next 10 years. Traditionally as well, federal law prevented the transfer of federal tax credits unless it was done through what is called a tax equity structure, whereby you actually had to be an owner in the underlying project. And that created some challenges. It's a complex structure. It is not easy to enter into, requires a lot of underwriting. And traditionally, only large financial institutions were the major players in that tax equity market. And the Inflation Reduction Act and the passage of Internal Revenue Code 6418 significantly changed that landscape, and it actually allows for the transfer of energy-related tax credits that are mostly related around investment tax credits and production tax credits, but we'll talk about a couple of others that were also passed that we think might be applicable to you all. And one of the biggest things is it significantly reduces the complexity. It looks more like a state certificated credit, whereby you have a certificate and you just claim that credit on your tax return. So a couple of the incentives that we're going to kind of try to highlight today, or a few of them. One is the Section 30C alternative fuel vehicle refueling, or as you might think of it, is just EV charging stations. So those credits carry up to $100,000 in credit for the installation of EV chargers. A couple of the caveats to that is that the EV charging system, in order to qualify for the credit, does have to be located either in a low-income community, as it's defined in the New Markets Tax Credit Code, generally an area that has a poverty rate of greater than 20%, or a median family income of less than 80%. It's something that can be looked at just in terms of a mapping tool to determine exactly where the project is located and whether or not it qualifies. The next two are probably more relevant, the production tax credit and the investment tax credit. We'll talk about the differences between those two here in just a minute. And each of these credits has an enhancement that it can also be added on in terms of prevailing wage and apprenticeship, domestic content, energy community, and what we call the environmental justice allocation. We'll talk a little bit more about each of those different enhancements here in just a second, but wanted to highlight those three credits. The other credit that's out there as well is commercial clean vehicles. So up to $7,500 for purchasing a electric car or small truck like maybe an F-150 Lightning or something along those lines, up to a $40,000 credit for vehicles that weigh over 15,000 pounds. So think of your large commercial vehicles. Those were the ones that also would qualify. So as we indicated, with respect to solar and wind production, which you typically think of in terms of green energy credits, there's two kinds. There's the investment tax credit or the production tax credit. You have to pick one incentive or the other. You can't qualify for both. So on the investment tax credit side, that is based on your eligible costs that go into building the facility. So if you're putting solar in and on a building, that's the costs that are associated with building those panels, the steel and iron that goes into it for the supports and those kinds of things. And the eligible credit percentage is between 6 and 70%, depending on if you meet all of the additional enhancements that we'll talk about here in just a minute. The credit is available in the tax year when you place the project in service. So if you complete the construction and flip the switch on a solar installation in 2023, it's a 2023 tax credit for you based on your tax year. One of the things that ITC and the investment tax credit does carry is it does have a 5-year recapture period, whereby if the property is taken out of service for some reason, there can be a recapture of those credits during that 5-year period. Conversely, the other side of this is the production tax credit. So these credits are based on the production and ultimately the sale of electricity or manufactured product in certain situations to an unrelated third party. There are some exceptions to that, but in general, it's the production and then the sale of the energy that's associated with that. That credit's actually earned over a 10-year period based on the production or amount of energy that's produced. So it's really a math calculation in a lot of respects if you're selling to a third party as to what incentive is better than the other based on the amount of energy that's produced or the costs that go into the system. Additionally, an advantage of the production tax credit is there is no recapture on the credit because it's based on the amount of electricity that's produced. Now, there is some prevailing wage and apprenticeship requirements for the production tax credit, but in general, that recapture risk is much less. So one of the things we wanted to talk about and bring to your attention is some of the investment enhancements, the tax credit enhancements. So this slide represents the enhancements as it relates to the investment tax credits. You can see down at the bottom of the slide, you start out with a 6% credit. That's the base amount. If your project is less than 1 megawatt in size, and just for reference, I've had people ask me what's a megawatt project look like. It's generally about 6 to 8 acres of solar panels. So it's a fairly sizable project. It's not something that's typically just put on top of your building. But if you're less than 1 megawatt in size, you qualify for a 30% tax credit. If you're over 1 megawatt in size, you have to meet prevailing wage and apprenticeship requirements. Essentially, this is paying the prevailing wage and also hiring a requisite number of apprentices during the construction of the project. If you meet either of those tests, less than 1 megawatt or the prevailing wage and apprenticeship, then you get this 5 times multiplier, taking your 6% credit to a 30% credit. The next enhancement is related to domestic content. So this is Buy America. 100% of the steel and iron that goes into the project has to be made in the USA, And then it starts at 40% and ramps up in 2027 to 55% of the manufactured products have to be made in the United States. So if you take your solar installation, for example, or your battery installation, those need to be 100% of the steel and iron need to be there, and then 45% of all those manufactured products, 40 to 55% of those manufactured products need to be made in the USA. The next addition that is typically qualified for, can be qualified for, is the energy community, and that gets you another 10% bonus. The energy community is based on being located in a census tract that has had a coal-fired electricity power plant closure, or an adjoining census tract to that, or if there's been historically been a certain percentage of employment in an area that is related to fossil fuel production, and there's a higher than average unemployment rate, that also qualifies for an energy community. The third way is based on what's called a brownfield test. If your project is located on a brownfield site, or a site that has been contaminated or has it potentially contaminated based on a phase 1 or a phase 2 environmental assessment, then that can qualify for that 10% bonus. 10% bonus. It's important to note that you can qualify for the 30% base credit and then not qualify for domestic content, and then also but be located in an energy community to still get to that 40% credit. The last two are the environmental justice allocation, and those two are either an additional 10% or 20% bonus. These are the only two enhancements that cannot be, that are not as of right, as we would say. You have to actually make an application and qualify for those. And so you would have to be either located in a low-income community or tribal land, or the benefit would need to go to an affordable housing or to that low-income community. And the IRS just announced yesterday, as a matter of fact, that application period is going to open up on October 19th. The next enhancements that we'll talk about, these are actually the same enhancements, domestic content and energy community, but they're in prevailing wage and apprenticeship, but as it relates to the production tax credits. So you once again start with that base credit percentage of that base credit amount, which is adjusted for inflation, is in 2023 is $5.50 per megawatt hour. Get that 5 times multiplier, and then 10% adders. Then the adders for domestic content and energy community kind of stack up on top. So if you meet all of them, you go from that $5.50 per megawatt hour up to $33 per megawatt hour. So you can see these enhancements are quite beneficial to meet in terms of the applicable credit percentage that you can generate related to your project. I'm going to hand it off to Adam now to talk about the transferable aspects and transferring these credits as it relates to that.
Thanks, Ben. With the background of the programs in hand, Ben and I wanted to spend a minute really to discuss transferability, since this is the first time that we've had a federal tax credit that could be transferred from one party to another without having ownership in the entity that is generating the credit. Transferability is fairly common if anyone's aware or familiar with state tax credits. Generally, the transfer of credit is treated as a capital asset sale, and you use this asset to offset your tax liability. With the efficiencies that we see in the state market, it somewhat appears that the federal government wanted to steal a page from that playbook and try and mimic the straightforward approach for the transfer of credits on the federal side. Transferability applies for clean energy projects that were placed in service on or after January 1st, 2023. One limitation to note, however, is that there's a one-time election to transfer these credits, but that can be for all or a portion of the credits that have been generated. To add a bit more clarity to this, a seller can transfer the entire amount of the credit to one purchaser or sell portions of the generated credit to multiple buyers. This transfer to a third party must have cash consideration in all cases, and proceeds are not part of the taxable income of the transferring party, nor can they be deductible by the transferee. but it's described in the third bullet. It's described in the third bullet on this slide. The gain on the discount is not taxable for the buyer. For example, if you purchase a credit, say for 93 cents, that 7-cent delta between the purchase price and $1 is not taxable, meaning you have a before and after tax return equating to 7%. The transferee will be able to use the credit in the same way that the transferor would have. You can carry it back 3 years or forward 22. As a seller of the credit, you have until the due date of your return, including extensions, to make the selection or determination of how you want to treat the credit. And finally, the transferee is subject to recapture from a purchased ITC. Therefore, it will be common to not only have certain sponsor guarantees for this risk, but also we see it kind of becoming more prominent in the market that tax credit qualification and recapture insurance to cover any risk of loss associated for your purchase is somewhat a kind of a term that we're seeing more and more regularly. In looking at transferable tax credit opportunities, there really are several considerations that must be taken into account, and we're going to highlight a few of those here on this slide. For corporations, transferable credits can offset the new global minimum tax. And since the credits under the Inflation Reduction Act are considered general business credits, there is also a limitation that your liability can only be reduced by up to 75% of that amount. For closely held C Corps, S Corps, and individuals, passive activity rules appear to still limit usage, but we are still awaiting final guidance from the IRS to confirm this position or intent. Each individual state taxing jurisdiction will have the ability to determine whether or not they'll conform to the federal position, but since they rarely take non-conforming positions, we expect that the state treatment will mimic the federal position. Finally, if a buyer can show intent, they can consider potential tax credit acquisitions when calculating their estimated payments, even before a transaction closes and credits have been transferred. However, if there is any shortfall in a purchase in a given year, a buyer might be subject to underpayment penalties and interest. For the next two slides, Ben and I wanted to really create or thought it might be best to try and distill the major steps of the credit transfer process for both the buyer and the seller into a couple of visual aids. As you can see, for the seller, we were able to silo the major steps in the process into 4 major categories: credit generation, buyer identification, credit registration, and finally transfer. As sellers, certain tax credit characteristics will impact the matchmaking with a potential buyer. Fundamentally, whether your credit is an ITC or a PTC, as Ben kind of gave you detailed descriptions in the previous slides, as well as the enhancements that have been utilized, these will all impact a buyer's sentiment and how they feel about your credit. Additionally, how flexible you can be with price, payment terms, and various recapture protections, will also impact the marketability of your credits. One item to point out is that we're still awaiting final guidance from the IRS on the exact procedure for the tax credit registration and transfer process, which is really indicated on those kind of two on the right side of the screen under those 2 chevron icons, if you will. While we do have proposed regulations and some idea of what this portal will eventually look like, it has not yet been released, and we hope that it is unveiled within the next couple of weeks. As buyers, determining your eligibility and the amount of credit that can or that you would like to use is likely the first threshold to clear. Once these items have been determined, the evaluation of various opportunities is likely the next step. Certain characteristics will inevitably guide the decision-making process. They might include the energy technology that you're considering, whether it's an ITC or a PTC, maybe price, payment terms, strength of the guarantor, the presence of tax credit, recapture or qualification insurance, as well as the various credit enhancements that might be in play that does affect the value of the credit ultimately being transferred. While we lay this out as somewhat a linear process, this by no means is a straight path. And we really have, proved this out in concept as we're negotiating transactions today, that as these discussions are had, trends will emerge and certain characteristics will eventually rise to the top as being significantly more important than others. A topic that's likely familiar, kind of moving away from the Inflation Reduction Act, but something we wanted to touch on just because it has made some recent news headlines lately. And it might be familiar to many people here on the webcast today, is the Employee Retention Tax Credit. For those that might not be aware, or just as summary, this credit really allows employers that experienced a partial shutdown due to government orders limiting commerce, travel, or group meetings, or that experienced significant declines in quarterly gross receipts as compared to 2019, are eligible employers under the program. The ERTC is a refundable tax credit for qualifying employee wages. Therefore, the credit's based on payroll taxes rather than income taxes. So a qualifying business can still receive the credit even if they did not pay income taxes in 2020 or 2021. The tax credit can be as high as $5,000 per employee in 2020 and as high as $28,000 per employee in 2021. Also note that this is a credit and not a loan. Therefore, it does not need to be paid back to the government by the employer. And for most taxpayers, and just through all the filings that we've done, we've noticed that the refundable credit is generally more than the payroll taxes that have been paid in any credit generating period. A question has come up with many clients about whether or not you can still apply for the Employee Retention Tax Credit. The simple answer is yes. The statute of limitations for the 2020 ERTC does not close until April 15th of 2024. The statute of limitations for the 2021 credit is just a year later, and that period doesn't end until April 15th of 2025. For any organization that might have experienced a decline in receipts or were limited in doing business by state, local, or government orders, could be eligible for filing a claim under the Employee Retention Tax Credit. Even if you might have looked at this previously, it might be worth a revisit because with experience, everyone has become more adept at qualifying partial suspension orders for taxpayers or unique situations. One last point on the ERTC, as I kind of touched on just a few minutes ago at the top of the slide, you might have heard that the IRS has temporarily suspended the processing of new claims through at least the end of the calendar year. The short answer here is that Moss Adams doesn't believe this is an issue for any valid claims, and we continue to process such claims for clients. The taxpayers who qualify for the ERTC should still continue to file claims with just an awareness that the IRS processing times may extend beyond current expectations. Okay. So with that, Amy, it looks like we might be to our polling question, so I'll pass it back to you.
All right, thank you, Adam. So yes, we are to a polling question, and it is located right on the slides that we're presenting. So if you can't see it, you can hit the F5 key to refresh your console. So the question is, I'm interested in learning more about, and then you can select as many as you would like here, qualifying for credits under the IRA, transferring credits under the IRA, buying federal tax credits under the IRA, qualifying for the Employee Retention Credit, or just here to learn. And we'll leave this up for a little bit here to make sure you all get time to submit your responses. And make sure to hit that submit button so that it does register.
And Amy, as people are making that selection, I'll remind you, if you have a question, please put it in the Q&A box there. That would be great. We welcome any questions that you might have. And then, Adam, I was thinking of a question that some people might have as we were talking about the transferability. Where are we seeing pricing? What's the discount that we're seeing in the market on transferable credits?
Sure, I think that's a good point, and one that we didn't really speak at length here in this presentation. But I think there are a number of factors that really go into pricing considerations. We did highlight sponsor guarantees, the quality of that guarantee, whether or not there was presence of recapture and qualification insurance. But if you do look at just kind of general trends, I'd say most credits are transacting if there is a kind of quality guarantor in the insurance aspect present. You're really looking at something in the low to mid 90s, so somewhere in that 92 to 94 cent range is where we're seeing most credits kind of transact, and that's price to the buyer. As far as if you were generating a credit and you're trying to sell, you're probably looking to net somewhere in the upper 80s, just with different fees and other professional type obligations that you would have that would kind of deduct from kind of that price from the buyer to get down to your net price. But I think that's a good question. If there was a situation where there was kind of a less than creditworthy sponsor, or maybe someone that doesn't really have a liquid position on their balance sheet, and there's no insurance, I would say you probably could get down, somewhere, the price to the buyer in that kind of mid 80s range. I can just say we aren't seeing a number of those credits, just because we're really working with sponsors that are trying to produce kind of the highest quality and the safest product to market. So not to say that they don't exist, because they certainly are out there, but I'd say from a pricing perspective as a buyer, you're kind of looking in that 90-ish cent range.
So it looks like we did have one question. Okay, yeah, thank you. Most people are here to learn, it looked like. So we did have one other question that popped up in the chat, Adam, and I'll ask it to you because I think you kind of have a pulse on this. Has there been any exchanges that have been established to help ease that transfer process for the credits, or what's that look like in the market?
Sure, Adrian, that's a really good question that you had. So there have been some portals that are out there that are established. People are trying to transact credits in that manner. I would say there potentially are some challenges to this, and I think it's largely dependent upon kind of organizational size. And I can go into what I mean by that rarely can one person kind of in a silo make a decision. So these exchanges are really set up that you're almost kind of, buying something like you would on Amazon, where you can go see the credit, put it in your cart, and check out sort of idea, where, that's really difficult for many organizations, because one person really can't make, a unilateral decision to do something like that. I would say we talked about passive activity rules for individuals, S corps, closely held Cs, and I think where that guidance will shake out with the IRS, really could impact, I'd say, the prevalence of exchanges, because, obviously if you're an individual, you can make that tax decision for yourself. So I think there is a lot of validity to potentially what is there as far as an exchange and what that process might look like. But I would say there are some out there, you are seeing them. We hear others that are trying to develop these kind of on the fly. But I think there's going to be some hurdles depending on where guidance shakes out to where this might be kind of going forward in the future and for the course of the next 10 years. Amy, I think we're kind of coming up on the last minute, and it doesn't seem like we have any more questions. So I'll turn it over to you to close us out for the day.
All right, thank you. So yes, we are out of time, but thank you, Adam and Ben, for your time and a great presentation. To our audience, if you have further questions or comments, please reach out to us and we would be happy to continue this conversation. You can drop a note in the Q&A window or reach out to Adam and Ben directly. Their contact information is in your console as well as in the slide deck, which you can download now from the handouts window. And finally, here's a survey for today's presentation, and your feedback is appreciated. Thank you for joining us, and take care, everyone.